Remember 2008? Banks collapsed and stock markets fell dramatically, giving investing a bad name for years. Over a decade later, people are still wary of investing. Our own research shows that 62% of Brits aren't currently investing. That's almost 2/3 of the population.
Investing does involve some risk, but it's a much misunderstood concept. Investing carries some risk, as your return is linked to the performance of your investment. So, there's a risk you could end up with less than you initially invest. However, there's also a potential for higher returns. So, why are people so reluctant to invest? Simply because they're afraid to lose money. Think about it. Stock markets only tend to hit the front pages when they drop, and naturally, investing becomes associated with loss in people's minds.
Investing comes with risk, there's no denying it. But for every risk you take, there's a potential reward. Take entrepreneurs, for example. When they first start up a business, they are at risk of going bust. However, if things go well, they could make a potential reward. It's the same with investing. It can help you build up wealth over time, but you need to take some risk to enjoy potential returns. However, that doesn't mean you have to take the plunge without a safety net. Just like starting a business, there are ways to manage risk when you invest.
One way to manage risk is to diversify your investment plan. All you need to do is spread your money across many different companies, investment types and regions. That way, poor performing investments are likely to be balanced out by others doing well. If you don't diversify and invest all your money in one or two companies, you could be in for a nasty shock if they were to struggle. So, make sure you keep all your eggs in different baskets.
If there's a quality every investor must have, it's patience. Remaining invested over the long term is key to mitigating risk. Over the short term, financial markets have ups and downs, a bit like roller coasters. And just like the popular thrill rides, market movements can be scary, but they're part and parcel of being an investor. So, it's important to learn to accept them and think long term.
Sticking with your investments for a number of years has many advantages. It gives your money more time to grow and can help smooth out market bumps. Evidence shows that long-term investing increases the chance of making a gain. For example, people who've invested in the FTSE 100 index over a 10-year period between 1986 and 2019 have had an 87% chance of making a positive return.
With robo-investing platforms, it's easy to mitigate risk. At Wealthify, we let you choose a risk level that suits you. You can be cautious, adventurous, or somewhere in between.
Based on your choice and other important factors, our investment experts will build you a diversified portfolio with just the right mix of investments. They'll also monitor how markets behave and adjust your plan if needed to take advantage of the good times and shelter your plan from the bad times. This is effortless investing for you.